Good afternoon, everybody, and welcome to this edition of Hardman Talks. My name is Mark Thomas, and I'm the banks analyst here at Hardman & Co. Today, we are joined by two executives from Bank North, a fintech-enabled bank fresh from receiving its UK bank licence. We'll hear more about its unique combination of customised technology and the trust of face-to-face banking, which has been built to disrupt the 150 billion UK SME lending market. We're joined by Jonathan Thompson, Founder, Executive Director and CEO, and David Broadbent, Founder, Executive Director and CFO. Bank North is currently unlisted, and it will shortly be doing its next round of equity funding, a substantial Series B, as well as a retail offering, and we'll be hearing about both of those.
Thank you very much, Mark, and it's a pleasure to be here. Just by way of introduction, my name's Jonathan Thompson, as you said, founder and chief executive of Bank North. A quick potted career, mainly in UK mid-market banking, so worked with the likes of Lloyds Banking Group and with Santander, latterly as a divisional managing director in its SME bank, and also time as an advisor in debt capital with Deloitte. And Bank North came together in 2018, which is when Dave and I first came together. Dave, over to you.
Yeah, thank you, Jonathan. So David Broadbent, CFO and one of Jonathan's co-founders. My career started at PwC. I was there for around 10 years and then spent most of my career at a business called International Personal Finance PLC, which was FTSE 250 listed business focusing on unsecured consumer finance. I was the FD there for 11 years and Chief Commercial Officer for two, including when it listed on the main London Stock Exchange in 2007. And then after a brief spell in another listed business, joined Jonathan and the other co-founders mid-2018.
So thank you. We've just got a few slides to share with you today. I'll just start by giving you a bit of background on the team. And I think it's fair to say that it takes people to start a bank, and that's one of the most important ingredients of our success. This team's been pretty consistent through the time we've been on this journey, and you'll see myself and Dave in the top left, but we're complemented with deep expertise across every facet of what is required to be a fully regulated and performing bank. That includes deep expertise in technology, commercial and operations, and every facet of a banking business. I think what sets us apart is that there's a real combination of startup and scale-up banking experience in this team, but also people who've been really close to the coalface of SME banking, and that's really where this business starts and finishes, is its proximity to businesses and insight into the requirements that businesses have, startup and scale up, in terms of their funding requirements and what they need from a bank. Behind that team, or alongside it, I should say, we're complemented by a fully formed board, so chaired by Ron Emerson, CBE, who was founding chair of the British Business Bank, and he's got three additional independent non-executive directors alongside, who have technology, regulatory, finance and audit expertise. So a lot of strength in depth across the team at Bank North. Alongside us, there's a team of around 50 full-time employees, all capable and experts in their field, but actually deepen and stand behind the commercial team in order to bring us to market successfully, and every other facet of the business to drive through this critical period of what's called mobilization of the bank, and deliver and come out with our deposit taking capability ready to scale our lending operations. So I think, look, this is a bit about what sits behind the business. And as Mark said in his introduction, we're a real hybrid of technology and people. And people is where a lot of the time investment has been expended over the past few years. So we've built a really compelling assembly, essentially, of integrated fintech capabilities. At the heart of the business is Mambu and Encino, which come together in our Bolt platform, and that's an integrated platform. So everything that happens in our core bank and our relationship management layer is fully reflected and single time keyed. But what this technology gives us is it's cloud native, so it's super scalable. It allows us to infinitely scale the business, and it creates great efficiency at the heart of the business. So we're not held back by any of the legacy that you might find in some of the very big banks, or even some of the more recent challengers, all of whom have legacy technology challenges to wrestle with. And that has two effects. One, it strategically diverts their attention, but secondly, it also means that they don't have that baked-in efficiency and scalability, which gives us very significant cost benefits. In terms of our platform, Bolt, we spent around 5,000 man days tailoring that platform so that it efficiently and directly serves the UK SME opportunity, which is where Banknorth has really been built to focus. So it sits behind the scenes, but operates very effectively to help us deliver 10 times quicker than the competition. But it also is highly configurable, so it allows us to scale the business, number one, into our regional pod network, so it's completely location agnostic. But it's also pluggable, and what we mean by that is, as new fintech innovations come along stream, we can integrate them or bring them alongside on the Banknorth journey, so that we've got a platform that constantly evolves and enables us to keep up to date and take advantages of new technologies and new capabilities as they come on stream. But it allows our people to focus on their core purpose, which is to serve SME businesses effectively in their regional markets through our pod model, which I'll talk a bit more about as we go through the presentation. So I just mentioned our pod model, and this is the human aspect of our business. So we've got a super efficient, scalable technology heart. And then in the regions of the UK, firstly in Manchester, where our first pod is located, we have our pod operating model. And look, these are really sort of in effect small regional banks, and they've been designed with every aspect of the SME lending journey set into a regional context. So we have ability to regionally underwrite credit, which is something that is lacking in the vast majority of the competition, who centrally underwrite their lending, and that creates distance between the borrower and the lending decision. Our model turns that on its head and essentially delivers every aspect of the SME lending journey into a regional context. That starts with underwriting. It includes valuation of collateral. A lot of the lending that we'll be doing has collateral attached. That's a key pain point in the lending journey. So our ability to value that effectively and efficiently helps us to accelerate delivery to businesses. And we have very slick legal processes off the back end of our platform. The senior facilities agreement that underpins our lending is architected within our Bolt platform. And then we've got very efficient call outs to any legal counterparties to enable us to deliver very quickly. Where that really starts and finishes, though, is at the front end with a team of expert lending bankers. So they face off in each of the regions to borrowers and to brokers who introduce business into us. And that's very different to most of other banks who have been slowly degrading their service to SMEs and putting relationships into remote contact centers in a bid to become more efficient. All that does is create inefficiencies in the customer bank interface, and it leads to a very vanilla proposition being delivered into the marketplace. So as I said, that model turns that on its head and puts a very regional flavor into the banking relationship, and a very agile flavor into it as well. As you'll see, our plan is to build that pod presence across the UK. So there's a chart on the right-hand side of that presentation that gives you an idea of where the future pods will be located. One of the areas we've been very much focused on is recruiting and building a pipeline of talent to work in those regional centres. And I would say that we've been very fortunate in that we're able to attract high quality individuals to join the business. A lot of them are attracted to the differentiated proposition and the fact we're delivering a highly authentic regional proposition into the UK marketplace. It just so happens to chime very closely with the level up agenda as well. So although there's a bit of a challenge in our central government, actually that sort of that agenda around level up and stimulating the regions of the UK is something that's very aligned to our ethos as a genuine regional bank. And what this slide is designed to do is to give a flavour as to where the competitive themes are within the UK banking market. So it sort of stratifies it by pricing. And I suppose in the super low priced area, you've got some of those very big high street banks who are looking for super low risk, super credit and policy compliant opportunities, and that's really the place they play. They're working with current account funding, which is gives them a cost advantage, and they use that just to play in the part of the market that just fits that highly centralized model that they're adopting in terms of delivery. So really, if they're in a big bank, they don't want things that sit outside or have wrinkles. They want things that sit in a very manageable, constrained policy. They submit credit proposals and they get benchmarked against that policy centrally in a remote location. If an opportunity complies with policy, it comes out and there might be a transaction to do, but those processes are slow and highly fragmented. 4 or 5 months is perfectly normal for a lending opportunity to take from initial conversation to delivery. Then in the regions, there's what we call non-bank lenders. So these will be lending firms who are probably funded by debt funds or other capital. And so they have a slightly higher cost of capital. And so they play in a market that has a slightly higher yield as a result. What we see with those is that they can be quite dynamic, so they can be faster. They're probably regional as well, and they'll place a lot more value and emphasis on the value of collateral. So they'll often look at the loan to value of an opportunity and have a view on that and provide a facility benchmarked against the collateral that they are taking hold of. And that has its place, but it sits in a very higher cost and higher yield segment of the market. Bank North is in quite an exciting middle ground, which means that we're regional, and we've designed the business with a lot of the facets of those non-bank lenders about being nimble, about being customer-centric, and about being regional. But at the same time, we're in a market where we can take account, because of our regional presence, of the differences that SMEs experience when they're going on a journey. So most businesses have a story to tell. SMEs don't grow in a linear manner, they grow in an organic fashion. And our model is being regional and being closer to borrowers allows us to meet with businesses and really get under the skin of the management team, what makes the business tick, and importantly, how they sit in their regional context and in their regional market. And that's a market that we're playing in. Those yields of sort of 4 to 7% is probably our sweet spot. And what we're finding is the level of competition, particularly regionally, is less than you might expect. You've got the big incumbents who are in that lower cost area. You've got the non-bank lenders who have a cost of capital that doesn't allow them to come down to the kind of level that we're operating in. So there's a slither of banks operating in that regional market in that middle ground, but there's a lot of opportunity in that as well. The lending market is very significant. So what we're seeing is a very rich seam of opportunity. Look, just to bring that sort of first pod to life, we've already started, just in fact this week, and you may have seen the announcement, started our lending activities through our first pod in Manchester. That pod has been in place for a good few months now, so they've been building up relationships in the regional market, and we've recently brought Bolt on stream, so that's fully operational, and the team are lending against them. But that part of being in the regional market means that we're building those broker relationships as well, and brokers are a core part of our proposition, a core part of how we originate business. Number one, we've got very strong relationship with brokers. So by design, we're fortunate enough to have some brokers who invested in Bank North right at the outset of our journey. They helped us to design core aspects of our model so that it plays directly into the sort of requirements of brokers and makes us very well aligned to how brokers operate. What I should say as well is that brokers themselves are highly regional, so they tend to be operating regional firms. So our regional model makes us a very natural partner to that broker population. So we've already established some really strong relationships with brokers across those regions. We started lending as well, as I said, and we're doing that on the back of a securitization facility, which I'm sure Dave will touch upon in his updates. But also we're building our pipeline of lending. So we've had a good number of opportunities through the doors already, in approaching 100 million, and we've just started lending, and that pipeline is growing very nicely in terms of that pipeline of opportunities to really build momentum. And what we're finding is there's a lot of opportunity, but there's also a lot of desire to work with Bank North. So I think what brokers respect is that there's a real appetite to have more liquidity in this market and have genuine operators in the regional banking market who can operate in a nimble way and deliver on the agendas of those businesses requiring finance. So we're getting a really exciting and positive reception from businesses and from brokers that we're working with. So what we've laid out here is our forecast for the next 7 years from a financial perspective. And I think if we'd try and look through this in terms of the key building blocks, it really goes back to that regional pod model that Jonathan talked about, which is unique. Each one of those pods will have their own P&L and their own balance sheet, which gives us the ability to look through performance across each of our individual operating units and also benchmark them against each other, which gives a lot of power, from an insight and analytics perspective as well. But looking at one of those individual pods, we've laid out expectations for each of them, which basically says that we expect them to do around 50 million of lending in their first 12 months from a cold start, and then build that to 100 million in year 2, and then gradually grow that to around 200 million pounds of lending per annum. And what that translates to is a few things. One, at a mature state, we would expect each one to have a balance sheet of around 550 million of lending. And we would expect each one to generate a contribution to profit to the overall bank of around 20 million pounds per annum. The other thing is, because, as Jonathan says, we've got the benefit of low-cost technology, the regional model is optimized in terms of staff levels, and therefore we expect each one to have a very short J-curve and move into profitability within around 16 months from opening. So as we roll out that pod model, you'll see that feed through in terms of the results for 22 and 23, in terms of effectively startup losses as we roll the cost base out, but the revenues are starting to build. And by the time we get into 2024, some of that initial wave of pods will be moving into profitability, and the overall bank moves into profit and builds profit trajectory thereafter. Just a couple of other points to make. One, our working assumption from an exit perspective is that the business should be capable of listing maybe around 2026, could be a bit sooner, could be a bit later. That's an exit strategy that's within our control to some extent. Obviously, we have to, that may evolve as and when opportunities arise, but that's our core assumption, that investors at this stage will be able to realize value around 5 years from now. And I think the other thing as well is that, we know as we go on this journey and we look forward over 7 years, there are going to be challenges and headwinds. There's no doubt about that. But what we've not done is built in every single opportunity available to us. You'll see on the right of the slide a number of potential upsides that are not in the plan. I won't go through all of them, but the two most obvious ones are, we've only assumed 8 pods in terms of this initial plan across major cities in the UK. There are far more major cities than 8, and one of those would include London, which in itself may require a number of pods to effectively serve that market. As a business, we also have international aspirations. We think this is an operating model that can expand into other markets. This is a universal problem we're looking to solve. The SME segment has been squeezed in lots more countries than the UK. The other obvious potential upside is around product extension. So we will be working closely with the commercial finance broker channel. They place around 20 billion of lending in respect of SMEs into banks and non-bank lenders. Around 2/3 of that 20 billion fits with our initial product set, but then the other third would relate to products such as asset-backed lending and
finance, which are not in our plan at the minute, but are obvious extensions when the time is right. So I mentioned before about, so 8 pods and the balance sheet, and that creates a loan book, over that plan of around 4.5 billion, which obviously needs funding. And I think, in simple terms, we would expect our funding for that loan book to come from 2 core sources. One would be secured funding facilities, securitization structures. That would be, the lesser portion, certainly be less than 30% of the funding. And as Jonathan referenced, we were delighted in December to sign our first securitization facility with Insight Investment, a large global asset manager, over 700 billion of assets under management. And I think, we have our initial debt facility of up to 50 million with them. And what we hope is that will be a good entry point for a long-term strategic partnership with a very reputable and very supportive partner such as Insight. Having said that, the bulk of the funding for the loan book will come from retail deposits. So, in the UK alone, retail deposits are worth 1.4 trillion. So it's a very deep and sustainable pool of funding. It's also much lower cost than securitization or secured lending facilities. And this was, why we've spent a lot of time to secure our bank license. This is a very it can be a challenging process. There are probably less than 30 banks that have been approved, in the last 8 years or so, and therefore it's a real asset, and it's a difficult one to come by. So with it, you get the reward of that low cost funding. To put it into context, securing fixed term deposits, which will be our core product of 1 and 2 year. You might be paying 1.5%. If you wanted to get secured funding, it would be sort of more than double, possibly treble that. So there's a big differential, and that enables us to serve a bigger proportion of the market as a result. So, a real prize, a real asset, but also gives us a competitive advantage to all of the non-bank lenders as well. I think, there's quite a few bullets on this, so I won't go through all of these. But if we take a step back, as you've heard, Jonathan, myself, and the other founders, we came together nearly 3.5 years ago, and we, at that stage, we just had an idea and a vision. We knew that there was a big market opportunity out there. I think in Mark's voiceover, he referenced the 150 billion. We knew that there was an undersupply, into that segment. But we had a lot of hard work to do to be able to, bring Bank North to market and serve that. As we sit here today, we're delighted that we secured our bank license last year. We've got market leading technology that we use to support that lending journey. We've got a superb team, and we've got a unique operating model. The closest to our operating model is probably Handelsbanken, which is very much at the top of the the SME service ratings. But we have the benefit of modern technology and a low cost operating base to support that. As we look forward over, say, the next 12 to 18 months, we're about to move into a different trajectory. So, in the coming months, we expect to be able to start taking retail deposits. As said, very deep, sustainable source of funding that will really enable us to leverage the business and grow it at pace. So once those deposits come on the stream, the next core objective will be to start that pod rollout across the UK. So over the next 12 months, we go from that first pod in Manchester serving the Northwest and open the next 3. So probably starting with Yorkshire and then London, not in the centre of London, but on the periphery of the M25, and then probably Birmingham in the Midlands as well. So we'll really start to ramp up the business and the balance sheet as well. As Mark referenced, obviously to grow the business, we need equity capital. So to date, we've raised 34 million from both retail and institutional investors. Our institutional investors do include LHV, which is a Northern European banking group listed on the Nasdaq Tallinn Stock Exchange, an SME lender in their own market. We also have Skipton Billing Society, which may be sort of more well known to the viewers. Again, an SME lender in the UK, and I think both of those, lead investors recognise the problem we're trying to solve and like the model that we're deploying to do that. We also have support from Greater Manchester Combined Authority, our local government, and Channel 4 Ventures. So with Channel 4, they have a media for equity model, and therefore with them we have TV advertising credits that we can use to accelerate the plan as we go forward, whether that's from a funding perspective or from a lending perspective. We are currently doing primarily a retail focused raise now. So we're currently on Crowdcube, but investors can invest directly with the business. When we get to the end of this presentation, we'll share our email addresses, and obviously you can contact us directly or via Hardman. Retail focused, but there is it's not exclusive. There's the opportunity for institutional investors to participate. But then, as Mark referenced, we've got our Series B round coming up that will open later in Q1 this year. That will be a £50 million raise. It's likely that for new investors, there'll be a relatively high minimum ticket to be determined. So it will be geared more towards institutional investors. But again, it's not exclusive. So there will be the opportunity for individuals and family offices to participate in that round as well. So I think that's probably the end of the formal part of the presentation. We do have our details there if they're of interest. But at this point, I'll hand over to Mark, who will kindly give us a good grilling on your behalf.
Brilliant. Thank you both. Very informative as always. What type of returns can investors expect if they invest in the current equity rounds? What are the key sensitivities and assumptions would you build in coming to those numbers?
Jonathan, I'll take this one.
Go on, Dave.
So Mark, obviously it's sort of quite a it's quite a complex area, but if it's okay, I mentioned that Series B round. So we've laid out our 7 years of projections. Obviously, we formed our own view in terms of what the business might be worth at the end of those 7 years. Obviously, I know your research notes present your view in terms of what that looks like as well, which I think has got some similarities. But I think, if somebody was investing in the Series B round, then we would be aiming for that investor to enjoy returns of, so an internal rate of return around 28%. I find it easier to talk in terms of money on money. So if I invest 100, how much do I get back? And we think that's going to be about 6 times. So 100 becomes 600, but only if they hold for the full 7-year period. Now, the biggest key sensitivity in the whole plan is around the size of the loan book effectively, and the return that we generate from that. So, the plan is relatively simple. We deploy these regional pods. Obviously, you get some of your cost base is fixed. Obviously, one of the key costs we've got is in terms of paying commissions to brokers and introducers for business. That's variable and is built into our net margin assumptions. But obviously, with that fixed cost base, the more lending you do, the greater the operational gearing, the more profitable you are. So to give you a sense of that, one of the scenarios we've done is and it's a relatively simple one, is say, okay, well, let's assume that the growth projections are 25% more than we've got in the plan. And that might mean that 6 times return becomes 7 times. If it was 25% less, then 6 times becomes 5 times. But there's some way to go, and we'll see. What I would say is, as Jonathan said, we started lending. We only really gave the green light to the commercial team to start building that pipeline once we'd signed the debt facility, which was early December. But so far we've been really encouraged and very optimistic in terms of the volume and the quality of opportunities that we're seeing. Probably better than we'd assumed, and certainly the pricing in terms of margin that we are giving terms on is better than we've assumed in the plan, which is positive for now.
Brilliant. Strategic one now. You've outlined a clearly differentiated strategy of regional pods to get close to the customer and the technology to deliver better service. The question is that UK SMEs in the past have been really, really sticky. What makes you confident they're going to come to you in a sufficient number to build a profitable model?
Yeah, I'll take that one then. Thank you, Mark. And look, a great question. And I think the important differentiation here is that how you define stickiness and how it plays out in the market. What my experience of is that current accounts are highly sticky. So if you're trying to dislodge a current account relationship from an established bank and bring it over to a challenger, that's a difficult thing to do. We all know through personal experience how painful it is, despite the current account switching scheme, how painful it can be to switch banks. And actually, it just feels a psychological painful experience, whether it is or not. So it's something that happens very rarely. And that's even more so for the current account relationships of larger businesses. However, debt is very different. So over the last, I would say, 10 to 15 years, many of the established banks that you'll know and love have been reducing or severing completely their frontline team. So a lot of the relationships that were part of that stickiness have been dislocated or have completely gone over the last 5 to 10 years. So a lot of SMEs now will find themselves banking or having the relationship through a contact center and having sort of telephony numbers to find out various parts of their banking relationship or to enter the banking system. For businesses who are borrowing, particularly for businesses borrowing £500,000 plus, which is the market that we're focused on, actually that's a really interesting segment, because these the terms of this debt is typically put out on between 2 and 5 years. So the standard commercial mid-market term loan is 5 years in duration, and so that means that every 4 or 5 years, the business owner is looking at the market and saying, I need to refinance my debt. I don't have any relationship with the bank that I used to be with, or they've exited. So I'm quite keen to look at what's out there in the market. That's where the brokers come in, because actually, as Dave said, 20 billion of opportunity is coming through the broker channel every year. That's very significant. So the brokers have become a very real and very permanent part of this process of supporting businesses when they're refinancing their debt. The debt relationship is completely sort of different to the current account relationship. So debt can exist over here without disrupting the current account relationship over here. So what's often happening now is that there's evidence of a very highly increased propensity to shop around when refinancing, not for the current account relationship, but to move the debt to different providers. And that 5-year cycle presents a very obvious opportunity to refresh terms and to benchmark them in the market. So what that means for Banknorth is that there's a ready flow of stock of lending coming to market at any one point in time. And our regional model gives us a point of differentiation, because we've got lending specialists in the regions that will be operating, and we've got underwriting in the regions. That's something that the brokers value and borrowers value, and we can deliver quickly. SMEs don't want to spend too much time working with the bank to refinance. They want to get the job done competitively and move on. So that time to cash, that reduced level of distraction is actually quite important as well. So we feel very confident about that. And I think our experience over the last few months has been, we've been in pipeline build mode, as evidence very much that there's a very strong stream of opportunities for us to take advantage of as we go.
Brilliant. Couple of questions on competition. What existing client relationships are you able to migrate to Banknorth, or are you dependent on commercial brokerages and fintech to attract and introduce totally new business?
In terms of our operating model, we've assumed that roughly 70% of our opportunities will come via that broker channel, and 30% will be self-originated. So we benefit from having an efficient and nimble team on the front line of experienced bankers. With them, they typically have a number of established relationships, either with brokers or with accountancy firms and lawyers, or direct with businesses that will result in opportunities that they can cultivate using their own network. We also know that as we grow and as we expand and as awareness of Bank North grows, then we'll get a certain amount of opportunities coming through the door direct to us just by virtue of our reputation and our presence in the marketplace. But 70-30 is our rough sort of split of that expectation. Sorry, I've answered one part of the question. Was there a second part as well, Mark?
Well, there was a second and a third question, actually. Yeah, who are your competition? And the third question was, in positioning Bank North for potential customers, is it necessary to distinguish yourself from other challenger SMEs like Starling or Recognise, or in practice at the moment, is it only necessary to say you're different from the traditional banks?
Yeah, that's a good question. We think we're different from both, but I think we're very different from the traditional banks, who are heavily centralized, very slow in delivering, and saddled with legacy technology. So we don't really feel a threat from them in the market, that sort of middle market that we're focused on. I think there'll be times when we might bump into them, but they'll be quite few and far between. In terms of newer names, you mentioned two very different ones, Starling and Recognise. So Starling is what you could term as a pure neobank, so it exists only on an app. It doesn't have any physical presence. And in terms of its direct lending capability, a lot of that is done through their online presence as well. And that has its place. Where a business requires short-term working capital support, then an app-based model can be quite efficient in accessing that. But the transactions we're working on are probably more material events for a business. So £500,000 plus is quite a significant and important transaction for the business. And that's where trust and regionality and face-to-face proper relationships really come into their own. So what we know is that businesses are very happy to transact day-to-day banking and small scale financial transactions electronically. But where it's an important event-driven borrowing requirements, or a significant one in terms of scale, then actually there is a lot of value in that trust and face-to-face relationship banking model. If you overlay on that our time to cash and the speed we can deliver, that's very helpful to that as well. I should say there's benefits of that regional model from a banking perspective. So we believe that having that regionality allows us to get in front of businesses and allows us to appraise not only the business off the page in terms of its financial performance, but also to meet management and get under the skin of the regional relative positioning of the business, what makes the management tick, and how they've navigated what have been complex waters over the past 2 or 3 years. So that sort of ability to have face-to-face relationships has real value from a credit perspective as well. And you mentioned Recognise, and Recognise probably sit in that competitive environment alongside some other up-and-coming challengers, the likes of alia, some of the fresher ones, I would say. So what they probably have is the benefit of cloud type technology, so they'll have some cost benefits of that. But what we see is that we considered the proposition for Bank North in great detail at the outset, and that's led to us having this very authentic regional model. So although other banks we see have a regional presence, they don't have that end-to-end prosecution of the lending journey in a regional context. And we think that has real resonance from a general sort of level up and regionality agenda, but it puts us closer to the businesses that we're supporting. Doesn't just put the first line of the bank closer, it puts the decision, the lending decision, the collateral valuation and the delivery of the facility all into a regional context. That's good for borrowers. They get to meet with decision makers and are able to influence and sort of support that journey. But it's good for our team as well. So our relationship teams in the regions have line of sight over every aspect of the decision-making process and the process of delivering a loan. So we can be much more nimble and agile as a result.
Brilliant. As a banks analyst, I'm delighted somebody's actually focusing on both sides of the balance sheet here. I think deposits are so often underlooked, so they don't get enough attention. So the question is, what strategy do you have to attract deposits away from the incumbent high street banks and away from fintech banks? Will this increase the cost of funds, presumably relating to the fintechs?
Yeah, thanks, Mark. So we touched a bit on deposits in the presentation, but just lay out a few shapes and sizes. So when we talk about retail deposits, initially our proposition will be fixed term retail deposits. So not current accounts, because as Jonathan says, they're very sticky, and it takes a lot in terms of marketing and brand building to be able to attract those. So we're looking at fixed term bonds, might be 1 to up to 5 years. And typically, so the depositors in those products are looking for, the best yields in the best buy tables, and effectively a new bank can get good volume from that strategy because depositors are relying on the government's financial services compensation scheme guarantee up to £85,000. So effectively, it's a risk-free deposit, and therefore you're looking for the best yield you can get. So it's a well-trodden path to access effectively comparison websites if you think about the money section in the Sunday Times, which will show the best rates that might be available on ISAs, but also they do fixed term bonds. And generally, if you've got, if you're in the top 5 of those at a particular point in time, you'll get strong inflow. Obviously, that may, being at the top of those tables means that you might be paying more for your deposits than somebody else and some of the other challenges. But to put that into context, we're probably talking about lending at, let's say, 5-year committed term loan at 6% per annum, but you're raising money, let's say, at 150 basis points or 1.5%, and every 5 basis points or 10 basis points will count. So the relative impact on your margin is very small, very different to the retail lending segment where, on retail mortgages, the margins are substantially thinner, and therefore, that pricing tension is a real issue. Now, what I would say, Mark, just to complete, so we're not just relying on the fixed term deposits. Our product set will evolve over time. We'll probably no doubt be introducing easy access savings, shorter tenor deposits, SME deposits, and whatever else. But as a go-to-market strategy, it's, I'd say, tried, tested, and so I'm very confident we'll be able to build a substantial business with that at the heart of our funding model.
Great. I'll try and squeeze 3 risk questions in one. One, are you going to exclude all low risk lending, so all sub 2% type of spread? 2, could you comment on diversification? I'm presuming that'll be not when you've done one loan, but when you've got a portfolio. And perhaps most importantly, do you intend to run the regional pod loan books and manage the risk of each book separately? If so, does this introduce inefficiency in risk management and associated costs? So, credit risk, over to you.
Okay, thank you very much. So I think first point was around low margin lending, and I think so. You mentioned 2% as a margin there, and I think when my experience in the larger banks is that that's an area that they're quite focused on, and obviously they have zero cost current account balances that they can deploy into those kind of lending opportunities. For us, they're a little suboptimal. So if you look at our cost of capital in terms of the deposit pricing that Dave was mentioned, deposit pricing even for 1-year bonds is around 1-ish%. So it doesn't make sense for us to focus on that market when there's higher yielding opportunities that have a good level of downside protection in the market, and there's a very good volume of those which aren't actually suitable for the incumbents because they haven't got the processes or ability to appraise those kind of opportunities. So I'd say 2% is too low, and we'd start to sort of cross over when we get into the 3s, I think. So there's probably a bit of grey area around that, and Dave's sort of nodding there, so I'll take that as a mandate to write that kind of business. In terms of diversification, that's something that is already a focus for the business. So as part of our interaction with the regulator and the regulatory framework, we have to be very cognizant of the diversification of the portfolio. For us, diversification is a good thing in that it means that we've got our risk as a bank and the asset risk spread across different asset classes, different sectors. So we have that sort of baked in resilience. But also it's something that we get through the benefits of the pod model as well. So it gives us an element of geographical diversification by virtue of the fact that we go on that rollout journey. So diversification is important. There's certain regulatory thresholds that we want to, and we have already set with the regulator, but that sort of geographical diversification is something that has value and will come as we go along the journey as well. And the final question, I think, was around the regional model and the risk management cost of that. And I think that's a really good question, because we have a regional model in terms of origination, and the management of our lending book, first and foremost, happens in the relationships that we have in those regional pods. So we have a very consistent approach and a very sort of authentic approach in the regional markets in which they operate. But actually, the credit management of the business in terms of oversight, in terms of the risk committees and asset liability committees, all of that risk governance is central. So we can harvest the benefits and efficiency of a centralized model in terms of the sort of monitoring and risk monitoring of the business. So we get a bit of a hybrid, I think. Our regional model is optimized. The brokers extend that regional model, but on a variabilized basis. So we get access to a variabilized origination source through those brokers who we only pay when they're introducing business. But we can centrally, through technology and some centralized functions, are able to monitor the business very tightly. It's one of the areas that we went through in quite a lot of detail with the regulator as well, to get the regulator comfortable with us running a regionally distributed franchise model when most banks have centralized. We went on a journey of explaining to them how we do that and how we manage the risks of that regional business. Technology helps that, because we get almost perfect visibility of every moving part of the business. So although we can devolve certain sort of delegations to our regional teams, we can keep an eye on those and the performance of those very closely through having really high quality information and information through our integrated technology as well.
Jonathan, if it's okay, I just want to add a couple of things. So, it's when you talk about sort of risk management and underwriting stuff like that, often they are, viewed in terms of cost and business prevention and all of those things. The underwriters are an integral part of our model, and one of the things that makes us different. And I think that creates opportunities rather than costs. So I'll give you two examples. So one, we speak to brokers all of the time, and one of the things that really hacks them off is, they'll go to a handful of lenders and say, will you give terms on, this particular opportunity? And in a typical bank with a typical process, they'll have a frontline person go, yeah, I think we'll be able to do it on these terms. And then they might get preferred bidder status, and then it goes internally through to a completely separate credit committee that's hundreds of miles away. And by the time they're ready to complete the transaction, the terms that were agreed up front have all changed. There's a covenant here, or the price or whatever else. And that's one of the, in terms of a broker that's trying to do the right thing for their customer, it makes them the villain rather than the hero. And because we've got the frontline bankers and the underwriters together in the same office, they can sit in the same deal forum every day as every opportunity comes in, and you get an immediate perspective in terms of whether it's going to be within our risk appetite or not. So I think that's a real opportunity, because it means that we do what we say we're going to do, which, is a bit old-fashioned but very valuable. But then the other thing is, by having them together, they can have a very rich conversation, not just about understanding the business, but is there a better way of structuring this deal in a way that works better for the customer? So you don't just take the ask that you presented with, you can go back with a next best offer or a better offer, but you can only do it by having the underwriters in that regional context as well. And I think what we've seen in the discussion we've had with brokers is that will be a really significant advantage for us as we are, competing with other lenders for business.
Brilliant.
Good point, Dave. And look, at the end of, actually, I'll just bring that to life. At the end of every credit committee, or as part of the dialogue in our credit forums, we have that sort of how do we differentiate ourselves? So that sort of next best offer is something that the brokers welcome because it helps them to look good. Oh, I've got these sort of different ways that, and the bankers looked at it, but also often banks just react to what the broker is asking. So if the broker says, I need this, and I'm looking at it on this terms, they'll get that back. If you can present an alternative as well, actually that might be better, or it might sort of prompt a thought process within the business that just helps with their particular agenda. And that point is really important.
So the final question really is, could you comment on how many more rounds of funding you expect? Will there be any further dilution? Will CrowdQ participants have a chance to invest in later rounds? So I suspect that's one for Dave.
So again, we've laid out a plan, and obviously, there's a long way to go. But in simple terms, so the next big round is going to be Series B. We've yet to finalise the planning for that, but I think it's more than likely that existing investors will be able to participate in that on a preemption basis. And as I say, that's a 50 million round, which enables us to sort of effectively start retail deposits and grow the pods from 1 to 4. The round after that, Series C, we've penciled in for 2023. We've penciled in 100 million for that. And the reason it's bigger is because as the pods come on stream, so we'll go from 4 to 8 pods, and as they start to have more and more lending opportunities, we need greater amounts of capital to support a much bigger loan book. So that's the round, say, go from 4 pods to 8, we'll move into profitability, and the loan book will start to pass £1 billion. And then at this stage, we've penciled in one more round, Series D, for 2025. With a view to that being a large, and again, I think, we'd look to give existing investors opportunity on a preemption basis to, maintain their state, but, we'll be looking, at large institutional investors to obviously do the bulk of that round. And that could be a round that's either an IPO or the last round before we do an IPO. And really that, by the time we got to that stage, we would expect the business to start to be self-sufficient from a capital generation perspective. Obviously, if there are further growth opportunities beyond that, in terms of greater expansion, products, buying loan books, then we might need to do a Series E and beyond, but there would be a virtuous circle in the sense that you're only doing it because there's an even bigger opportunity out there than we'd anticipated.
Brilliant, excellent. I will do a no shame held barred a sort of plug for our note. We did a big note, and a number of issues like the risk and diversifications, etc., are covered by that as well. But beyond that, thank you very much indeed to our guests. Yeah, very, very, I think, insightful presentation, very clear answering of questions. It would be extremely helpful if people could conduct the poll. Thank you for our attendees. As I said, we had a huge number of questions. So thank you, everybody.
No, thank you, and thank you to the Hardman team.
Thanks very much.